Core inflation in Singapore is predicted to stay high going into next year, possibly topping 5% in the first quarter. And while it should ease in the second half, the Monetary Authority of Singapore expects it to be above long-term historical averages. Compounding matters, the spectre of what the central bank describes as muted economic growth in the coming quarters.
Food and energy aren't as expensive as earlier in the year, but with geopolitical tension and underlying supply factors at play, the MAS expects prices to remain elevated. Couple that with higher wages that businesses have to pay in a tight labour market and an upcoming GST hike in January, consumers can expect higher prices to stay for a while longer. The MAS forecasts in its macroeconomic review that core inflation in 2023 will average 2.5 to 3.5%.
The only issue really is to what extent consumer within Singapore, rest of the world, can take the higher prices, the higher cost of living in stride. The moment we see labour market conditions softening, the moment we see they stop spending as much will be when we will start to worry whether we are in stagflation period or whether recession risk has increased.
It's a scenario that the MAS is warning of as well. It says the dynamics between global growth and inflation are worsening, potentially spilling over into an economic downturn. Singapore's economy is already feeling the effects of a slowdown in external demand and in the electronics industry. While GDP is forecast to expand by between 3 and 4% for the whole of this year, the MAS expects growth to slow to what it calls a below-trend pace next year. But there are bright spots.
Singapore services growth has been robust, really in part due to the uptick in visitor arrivals, and a tighter domestic labour market of late. So really we will see a tale of two cities perhaps. First and foremost, for one, the services industry may continue to underpin Singapore's growth, especially if we head into 2023. Why? Simply because even as of now, the visitor arrivals still continue to recover, although we still remain below pre-COVID levels.
The MAS says slower global growth will impact labour demand, but wages are still expected to grow, just not as fast as before.